As you grow old, the arthritis creeps in, the diabetes comes in, the blood pressure comes in. These come. So we need to also prepare that. These all add to the total expenditure, monthly expenditure, which cannot be covered by the pension scheme. So I just wanted to add that to the decision.
Thank you very much. A big hand for Mrs. Chafulumira. Now, this issue of security keeps coming up, and now let me come back to James with my next question. What role does long-term investment discipline play in retirement security? Because, I mean, all the issues that are coming up, the challenges that are there when people retire, can be sorted if somebody is secure enough, if they plan properly for their retirement. Yeah, please proceed to respond to my question.
Thank you for that question. But before I address the question, let me just make a comment on what Mrs. Chafulumira mentioned. Because she mentioned a critical bit that most pension members miss. And that is most pension members rely on the pension. I think it's an issue that has been raised before by Director Chihana. You mentioned that we try to lump everything into the pension. But a critical bit is also building a side portfolio, a pension, not just relying on the pension, but building an investment portfolio that is going to augment what you're getting as pension in the decumulation phase. And I think that's where, as fund managers, we come in very handy, because we, aside making sure that the pension is growing, we also help you grow your other portfolio, something that you can rely on in a later stage. But now coming to your question, because we've talked about several risks, and we're now saying, as members, what should you focus on to ensure that you are getting ready for retirement? And I just touched on one bit, making sure that you are having an investment portfolio. It can be in different types of assets. It can be in shares, as Mrs. Chafulumira mentioned, because there you also register good growth. It can be in interest-bearing assets. It can be in property. But the idea is you are building something that you're going to rely on later on aside the pension. The key issue that comes in is the issue of patience. Because sometimes when you are investing in these markets, the markets are volatile. You invest in shares, share prices will go up, share prices will come down. And there's a problem with most investors, and that problem is to make emotional decisions. Hey, it's going down, let me exit. And then you end up losing out. You cash in at a time when the market is going down. So what is very key is to remain patient and having a long-term perspective. Because over the years, what your benefit is going to be determined by how much patience you have had with that investment. Understanding that this is a long-term investment and not just something that is short-term.
I'm sure it's very clear, and it's helping us make some decisions along the way. Now let me come back to Makhumbo. Many times we have issues where in the workplace we don't have much information regarding pension issues, and people take interest as the years are getting closer. And to some extent, I feel like if there was a way our institutions would, simply educate us prior, we would make better investments and make better decisions. And it could also minimize some of the challenges that are being addressed right now. So how can administrators make the transition smoother and more human-centered? Because it's like a cat and dog situation towards the end as people are retiring. I want my money, this is not what I expected. How can that be managed?
Thank you, Angel. I mentioned earlier on the information gap, and one of the initiatives that we take is on conducting financial literacy sessions. I wanted to add on to what Jess is saying. One of the challenges that we have actually faced is there are instances where we as pension administrators, we together with asset managers go to an institution to have these financial literacy sessions, and only 5% of the people show up. So you actually see the interest when it comes to pension. There's just this mindset that I don't need this money now, so it's not important now. But then when it comes to retirement, that's when they start panicking. We've had instances where members are actually negotiating with the employers not to retire because they're not ready. But I don't think we should get to that point. This is, as you mentioned, just an inaugural session. We plan to have more of these, and we've been going to employers, we've been having such sessions, but also it rests on the members themselves. Apart from administrators and the employers, the members also need to take interest in their pension. I'll give you an example of one member that I will never forget. So this one was a cleaner. He had worked for quite a number of years, over 15 years, and he was retiring. He brought in a notebook for 15 years of his pension. Every year, employer contribution, employee contribution, this was a cleaner. And he actually said, at a minimum, this is what I'm expecting. You can tell. And there are so many of us who, you get the statement, you don't even check whether your annual contributions are correct. And then at retirement, you get to wonder why you feel you're not getting enough. So apart from the administrators running these sessions, apart from the employer, I think the members also need to take interest in their pension. This will also help us in some way when it comes to arrears, because as administrators, we can only send reminders to the employers, we can report them to the regulator, but it's not our money, it's still the members' money. They have more power than we do. They can take the employer to task on the arrears. We cannot. Maybe the regulator can. So when the members also get such interest, I think it will help them. And also in this session, there are different stakeholders. We have HR people, we have trustees. We believe that they are very critical also to help members plan for retirement. We trust them to take this message to the members, especially I think HR people, because they get to interface with these members. So it really gets down to everyone, to the HRs, to the trustees, administrator, and the members themselves to really help the member plan for retirement.
Thank you, Makhumbo. Let me now come back to you, Mr. Chihana. There are two questions for you. If you can make them brief for me. What regulatory gaps still exist in improving retirement outcomes, and how is financial literacy being integrated into regulation efforts? I know you touched a bit on that earlier on, but maybe you wish to start.
Yeah, so in terms of the gaps, I think for us, what we see is number one, the early withdrawals. When you look at the law, it does allow members to actually withdraw contributions much earlier than their retirement, depending on the circumstances in which they find themselves. Generally speaking, it works against the achieving the retirement objectives. By allowing someone to withdraw their savings, essentially you are reducing the likelihood that they are going to retire with a meaningful amount. Number two is also to focus on income replacement. Perhaps if we want to allow people to either withdraw or take lump sums, we must do that only if they are going to meet or achieve a certain replacement of the income level. So we can set a target, for example, that if you are going to replace your retirement income at 40%, that is to say, if you are receiving 100,000 in your retirement, you'll be getting 40,000. Then if you are getting 50,000, then you can get the excess as a lump sum if you wish. But if it's below that, it surely you must not get a lump sum. So that's something that we can consider. I think there are areas to do with data. We still think there is a big room for improvement in terms of data, sharing the quality of the data that is obtained by administrators. This is an area that we're working hand in hand with the administrators, and so we believe that this is an area that we will continue to see how best we can improve on that. In terms of financial literacy, the Reserve Bank has done a lot of work in this area, including trying to introduce financial literacy in the primary schools, including the secondary schools. And so we have integrated some of the financial literacy in the school curriculums. I believe by now, I think for secondary school it is done, but we have been working hand in hand with the Ministry of Education to finalize, I think, on the primary school. For tertiary, I'm not so sure if we're working on that, but I think the focus has very much been in the schools. Outside that, of course, as you know, we also do hold awareness weeks. But I think the biggest challenge is funding. To a greater extent, we have relied on the World Bank to finance us on most of this. We must find ways in which, even as an industry, we are able to finance some of these initiatives. Because as an industry, for the service providers, they are getting business from that space. So clearly, by increasing awareness on pension and making sure that we have more people on pension, that will also increase business opportunities for administrators. So we expect administrators, asset managers to also play a part, I think, in terms of financing the financial literacy. So that's what I would say.
Thank you very much, Mr. Chihana. Let me quickly go back to our two retirees. What advice would you give to someone who's retiring perhaps in the next 5 to 10 years or even 15 years like myself, because I've now started to take interest in those calculating? What advice would you give to people like us?
My advice is to start business, investing while you are working. Don't start investments or business on the retirement check. It's easy to invest while you are working. After retirement, please, you have to change your lifestyle. Don't be so ambitious. Start it slowly. It will pick up itself. There is Continental Asset Management who can as well assist us on long-term investments. They are there for us. Thank you so much.
Firstly, if it's possible with your employer to increase your contribution towards the pension fund, please do so, because that will help you to get more when you retire. You can start now. Secondly, that additional income that you might have, please invest it wisely. And it should be an ongoing thing. As long as you're working, save some money for the day that you shall need it after retirement. In my case, when I get that excess funds, I still invest because I don't know for how long I'm going to live. But then, just for your information, the pension administrator, if after every 5 years, he comes and says, knocks on my door, are you still alive? You've done that for 15 years. I'm expecting another knock next year. Yeah.
Quickly wind up. It's basically about the biggest misconception people have about pensions. You as a regulator, what practical changes would significantly improve retirement outcomes in Malawi? I know you pointed out a few others, but maybe in your own words, based on your experience, what would you say about that?
Thank you. At the risk of repeating, yeah, I think let's see as much as possible minimize withdrawing earlier than the retirement. Let's also make sure that the investments are done prudently and not go for excessive risk. Pension funds should not have a high risk appetite. They are not in the business of gambling. This is people's money, and therefore we must take caution when the trustees are making investment. Take nothing, and the rest of the amount I will either invest in an annuity or a program withdrawal. That is what is going to ensure that you end up with a higher level of income replacement in retirement. So I think let's think about these things as continue to talk about them as we go, so that we can end up with better pension outcomes. Thank you.
I wanted to make a quick comment on directors' sentiments on the misconceptions. You know, I get knocks on my office very often of people saying, you know, the money you're keeping is not meant for me. People are going to fight for that when I'm dead. So I'd rather enjoy it now than someone else fight for it when I'm dead. But we've heard from retirees, what if you access all that and then you're still alive? What will happen? And you sit down with these people, you find out that they actually have maybe children, some are still in primary school, some are in secondary school. We don't get to think of what will happen to these children. So I know there are a number of financial literacy sessions that are running, but I think we still have a lot of work to do in terms of educating members. And I've forgotten the question you asked me.
How can stakeholders better prepare members emotionally?
Okay. All right. I think that's something that we commented on also, and maybe just to add on that is we still need to engage these members even more. I like what the regulator is doing. I should mention there's the department records that they mentioned. I wanted to recommend, I wanted an opportunity to mention them because I've really seen an impact in the industry of what they're doing. First and foremost is when it comes to arrears. There's been improvement, I should say, tremendous improvement in terms of employers setting arrears. This is building confidence also in the members. Emotional, I think it's also helping the members. And also the second one is now the notices that have been sent to members. It may seem like a small thing, but you know, the reminder when it comes, I think it sticks something to the members to say, I need to do something, especially the fact that the notices will come with a quotation of an annual program with growth. This gives them an idea of how much they should be getting. So as they think, they start to think about these things. I'll be retired in the next 10 years, and then you get another in 5 years, and then annually. Surely, if you're someone in your right mind, you should be doing something about it. And also the third one now, he talked of voluntary contributions as well. There's a law that came in. Voluntary contribution is now well structured, and I think it's something that members should take advantage of. There's the mandatory, and then this is that you decide how much you can be contributing. You see your notice, and you actually find out that I'll be getting maybe 10% of my salary. You can plan to say, I want to be getting 80% of my salary, and it is you who decides how much you should be contributing to get to that amount. So I think with the initiatives that and the laws that have been put in place by the regulator are very commendable. I think these are helping also our members to get prepared for retirement.
Now finally, to you, James, before I come to the audience, how do many people prepare for retirement accumulation but not for
Grow those investments, because these are the investments that we need when we go to the other side. Now, this is the time when we are decumulating. At the time we are accumulating, yes, we have the energy, and we can be able to take different kinds of risks by investing in businesses. We can invest in the stock market and the like. But now then we are moving from accumulation to decumulation. At the decumulation stage, our focus is we should have enough to draw down from. And at this phase where you are actually changing, it's also important to look at the types of the investments that you have, because you have to prepare yourself now for the next phase, because then you'll be drawing from these investments. I can give an example that at an early stage, we can have a lot of investments in, for example, listed equities. These are long-term investments. But as we are going towards a decumulation phase, then we start, in our case, we advise our clients to reduce a bit these long-term investments and create a portfolio that is going to contribute to liquidity that is going to be needed. So this phase of changing, it's important that you should at least consult investment advisors to assist you structure the portfolio properly, so that you are not facing challenges when you are decumulating. Thank you.
Thank you very much. Now it's time for you, our audience, to make your comments or ask some questions to our panelists, and of course our speakers can also chip in where there's need. Yes, there's some two hands.
And there's also another angle where the law is allowing the employees to increase the contribution rate. So I find it important. I know we know it already, but I'm asking and I'm thinking, how could we make it loud enough? How could we make the noise that all the employees understand this concept and they take advantage? I build on what the retirees were saying, that if they have a side investment portfolio, maybe some investment, now this one they are already taken care of by the asset managers. So by the time of just increasing the rate maybe to 10% or 15%, as the employer is also contributing. In my company, a lot of people are doing it. They make 15%, maybe 10%, and they see the member account. They see that when the funds grow, they also grow. So I wanted to make it more loud that the other option is just to increase the employee contribution and let the employees know about this. That's my comment. Now the question. I think Makhumbo, you mentioned about the problem of arrears, that some employers not contributing and the like. I was thinking that I know we have the regulator, the imposing penalties, and we also check with the employers when the people are retiring. But what about this opportunity cost, where if the money had been contributed, it should have been growing. So the interest part of it, the growth is it might not be the same money that the members would have gone out with when they are retiring. So I know you asked him, I mean you mentioned it Makhumbo, but maybe the Kaluso would punch in how would the members now enjoy the money that was held by the employer, and what the laws and the issues around that. Thank you so much.
And Thank you so much for that. So, indeed, as we mentioned, that arrears are paying right now. And what the law provides to protect the members is that when the employer is in arrears, it's got a penalty interest that is paid together with the arrears. So a director pointed out on that there's the policy rate plus 10% that is supposed to be paid together with arrears. So this is distributed to the members as the interest forgone because of the arrears, so that members don't lose out on the interest that they would have earned had the funds come on time. Maybe Director, you'd want to add more to that.
Thank you, Makhumbo. I think nothing much to add, other than to say that the interest is actually compounded. Is it monthly? Shamis?
Yes.
Compounded monthly. RBM policy rate plus 10%. So you add those two, calculate the interest, and you compound it every month for as long as it is not remitted. Thank you.
Thank you so much.
Mine is related to the same question from Night Funk. First of all, thank you, Cam, for organizing this. It has helped me a lot in terms of bridging the knowledge gap that existed. Mine is a complement to what he's asked about the regulatory mandate to pause penalties to employers in cases where they don't remit the fund. Apart from that, but you have that mandate where you can subject the penalties. Are there any strategies to ensure that we achieve efficiency or ensure that employers really take the responsibility to remit the fund on time to take away the risks that Angel asked at some point, what are the risks that could be involved? So in order to take out those risks, are there any strategies that the regulator or the pension fund can put in practice to complement the already strategies that are there in practice? Thank you so much.
Which will be able to interface with the administrator systems so that we can be actually tracking this on a live basis as to whether employers are remitting on time or not. Because oftentimes we have also seen situations where some administrators would actually protect some employers for fear of losing business opportunities. So if an administrator reports an employer in the Reserve Bank, and the Reserve Bank imposes a penalty, the relationship becomes a bit sour. Why were you, relaying this information to the regulator? So sometimes there's a little bit of administrators trying to protect their business interests. So we are hoping that once we develop this system, we will be able to interface and we will be able to track. But apart from that, we have made enhancements in terms of the enforcement. That's why we have had to create a whole new department altogether, the patient compliance and support department. It is focusing primarily on employer compliance. And our department, PISU, is only based in Bad, but PECOS is in Nzuzu, Lilongwe, and Blantyre. So it means that the presence across the nation is also there. And there is scope for us to even improve on that if the initiatives to perhaps think about an independent regulatory authority intervention. So that's another issue that is something that we are in discussion with government to see whether we can still pursue that. Thank you.
There's another hand. It's your turn now.
Malawi's Corporation Pension Fund, I'm a trustee. My question is to the Regulator. I want to go on health insurance. Why don't you just introduce some minimum deductions that should be deducted from the employee, and the employer should also add something to help to cut the former employees after when they have retired. Because you can take the example as RBM has got, he called it Desmond. I think they access it even after when they have retired. I think he can use the same implementation that he did with Desmond to the maybe pension funds or to the employers, so that they can be doing a little bit of contribution to tackle the health of the former employees after they have retired. Because most of them, after retirement, as they have stated, the retirees, what after retirement is death. Because you are not able to access the same, you cannot be able to go to the same hospital that you used to go. You just go to these shabby clinics. That was just my comment.
No, thank you so much for. But there is some ongoing conversations with government on the medical side. We had once prepared what we call a medical aid schemes bill. That bill actually, its main focus was just to regulate the existing medical schemes. But I think the Ministry of Health is having alternative thinking. Perhaps maybe we can enhance this bill to introduce what they are calling universal health insurance in Malawi. So it's a government initiative. Unfortunately, it's not necessarily in the space of pension. So the Ministry of Health is the one that is actually championing in collaboration with the Ministry of Finance. So, but thanks for the suggestion. I think the only way you can do it actually is that way, where you simply introduce mandatory deduction for every employee. But as to who now provide the service, that becomes an issue because you still need to fund that service as well. Yeah, thank you.
So we'll take two more questions and we'll hear from panelists. Two more questions. And mine is a comment. For so long a time, the emphasis has been people have to join pension fund, people have to join pension fund. But I think from the presentations here today, it's coming out clear that the pension fund or the pension income that people get at the end of the day is not enough. So we need to change the narrative. We need to change the message where we need to tell members that maybe the pension income would not be enough as a point of as a matter of fact, and then we need to encourage people to either make extra contributions or emphasize on investments. I think those are the 2 points that I'm getting out of here, that the pension income is not enough, and for us to improve on our pension replacement income, we need to either make more contributions or make investments, and that has to be communicated to the members quite early. Thank you. There's a gentleman behind you.
Public Service Pension Fund. My comment is only the need for people or members to understand the pension. But my fear is that issues of financial literacy should be escalated or should be tackled seriously, because here we have problems in having our members even to accept that they should be deducted or something should be kept for them in form of contributions. But the need for money after the work life even touches those that are not working. People that are not working, they are doing maybe they are doing businesses, ought to also have something they will rely on after they have stopped being active in their endeavors. This calls for what I indicated to say there is need for scaling up the awareness that everyone should know that I will need money when I am no longer active. So the issue of focusing on contributions of members to be contributing and they understand their pension, but those that are not working, like the social security setting where everyone should have something that they will rely on, should be it the regulator or the government should do something to enlighten people or everyone that they have to be doing something that will help them when they retire. Not from the formal employment, but even from whatever they do. My emphasis is only financial literacy because if the resistance is coming from those that are working, you can imagine how people that are private or business people can resist to be keeping something aside for their retirement. So all that boils down to the need for financial literacy and awareness. Thank you so much.
Pension fund for my friend for the public pension fund where there are thousands of members maybe each year and it's entirely. I think it would be cumbersome for the trustee to get the code for each member that is retiring. So my suggestion is, can the regulator just create a centralized digital system like the MRA has one? Because, for example, when you are buying a car before, MRA just plug into the system, you put the amount, the date, it gives you the estimated amount of how much tax you pay. So can the regulator just create a centralized system where members can go there, log in, and they'll get all the products that is offered by Continental asset managers, Mutual, Nico, and you get an estimate how much you get.
Before we come to the last two, maybe
that we are actually in the process of developing a centralized national pension database. It's something that we have attempted to do before, but unfortunately the consultant that we had hired let us down. We ended up with a system that was not working in the manner that we wanted it to. So we have had to resuscitate the project to start doing it again. Yeah, I think the comments from Boyd, I fully agree entirely. And I think the informal sector is the largest employer in Malawi. So it's safe to say that the majority of the economically active people in Malawi are actually working, are self-employed. And therefore they may not have actually access to some of the systems. Although the Act has provided a window through the voluntary personal pension plans and also provident funds. So the law, from the perspective of the law, is that opportunity, but clearly the need for awareness is very high. And surely I think it cannot just be up to the Reserve Bank. Financial literacy, by the way, is very expensive, because if you're going to do it, you have to buy airtime, things like that. You know, you have to travel if you're going to have physical presence. We also do use, of course, media platforms, social media, but generally it's expensive. It needs the support of everyone, and I think that's why earlier on I made a call that even as market players need to do a bigger part on this. So yeah, I think we are agreeing entirely on that. I think the other one was a comment, speaks more, I think, from Cham. Cham is one of my favorite pension funds because I've seen it grow, even in terms of the way they manage the pension fund. From the time when we make them the first time, I think, to the time when you meet them now, you actually see a transformation in that pension fund. So we really appreciate, and I think I can't agree with you more. We need to make people aware of the fact that they can make contributions over and above the minimum. It's just the minimum. For your information, myself, I started making contributions, extra contributions, I think some 5 or 6 years ago. We have a provident fund. I contribute more than the minimum that we set. On the mandatory scheme, I also contribute more than the minimum that was set. So, because I know when I retire, I'll be one of the people that will look forward to and say, do I need to retire in time again? Because it was one of the biggest proponents of the Pension Act. But apart from that, it speaks to the need for retirement planning. I think retirement planning goes just beyond pension. I think that's the message really that I think you can take away from here. Thank you.
Thank you. Let's have the two elder hand here and then come to your table.
Well, I suggest that maybe you kindly offer yourselves to provide some education to the churches where ministers also retire. But you know, they retire on a very, very low income, and they retire from even receiving a tithe from you. They retire from receiving almost everything that they used to receive when they were in the system. And the scare is probably higher when they tell you that you have to retire, because everything in terms of finances just stops. You've got to think of life and how to survive thereafter. But my question at the moment is, over the years, I used to rejoice so much on the little investments I had, because I could actually see the figures go up, the shares go up in value, and even the cash deposits go up. But now I can see a very quick erosion on my finances, on my portfolio, that instead of going up, I'm losing so much value. I just wanted to learn what I can do to hedge my available little bit from this eating away that is coming in. I need a system that can hedge my little income, my little investments from totally being taken away. I don't know whether I'm making myself clear. Yeah. The economic situation at the moment is eating so much on my portfolio. What can I do?
Thank you very much, because just over the past maybe 3 years, the market has been performing really well. Prices have been going up significantly. I think last year, 2025, that's when the stock market performed the most since the inception of the stock market in Malawi. The return last year was 247% average return of the market, which is the highest ever on the Malawi Stock Exchange. And the return was higher. I mean, in the past 2 years ago, and even 3 years ago, the market witnessed a high return. Now, you've also talked about the interest bit, because currently interest rates are also going down. I'll talk about this too. The interest part is largely to do with current policies that government is implementing in trying to reduce borrowing, but also to reduce the interests that they are paying. And that has affected really the interest bit, because interest rates are going down. On the stock market, there are quite a number of reasons why the stock market is performing as is, but I think the main one is that in the previous few years, the market went up significantly. And in some cases, maybe some shares were trading above where they should have been trading, and prices are trying to correct. So those are factors that we tend to meet at times. In fact, there are years when the stock market can go you can have a negative return on the stock market. And there are times when the interest rates can go down. I think the lowest we have seen on the market in recent years, in 2019, the Treasury Bill was even at 4%. So the interest rates went down significantly. But what matters most is that where is your investment versus inflation? Because you agree with me that the levels of inflation that we have now are not the same levels that we had 2-3 years ago. The levels of inflation have gone down a bit on average. What is important, like I said, is to ensure that your investment is at least giving you a return that is covering or earning above inflation. And the focus should be on the long term and not just on the short term, because these are fluctuations that are happening in the short term. Like I said, there are years when the market will be very volatile in the short term. But when you look at it on a long-term average basis, you see that the return is good. If we plot, for example, an investment that you might have over a period of time, and compare to average inflation over that same period of time, you will see that your performance is better than the average inflation over a period of time. So that's what matters most. Like I said, don't be worried too much with what is happening in the short term, but let's look at it on a long-term basis. I hope that clears it.
Yeah, but who knows the long term?
Yeah, I just wanted to comment. I think you also mentioned the issue of the need for education for churches, church ministers. We'll take note of it where resources permitting. We'll advise our colleagues who actually conduct the awareness. But I guess it also goes to Continental. That you have been informed here. So take note. I'm guessing it is something that you can also step in if you have the resources. So maybe to James, I wanted to say that maybe when you are talking long term, if you are talking to Makhumbo, it makes more sense. But Abusa here is a senior citizen. So when you start talking to him about long term, it will not work. Maybe you should be saying, how can he mitigate, like making sure that his investments are protected, like they are insulated from the losses that he's experiencing now, so that it doesn't, because I think his immediate concern now is in the current consumption. So perhaps the long-term one, I think it will not work for him. Thank you.
Let's get the final question from Mr. Handler.
Thank you, Madam Moderator. My name is Makpetri Hanja, and I'm retired since 2008. And just to say that I've been fortunate. I mean, we've been in that our knowledgeable moderator has asked a lot of the questions that we have wanted to ask. I think the kudos to you, Madam. I have a couple of questions, but before we that, I just want to reiterate and reinforce what Madam Suliwa said about the need to take efforts to invest whatever little we might have upon retirement, and reach out to Continental Asset Management to help us, give us direction in terms of how best we can derive benefits from those investments. I have been working for over maybe 10-15 years. The little something I had upon retirement, I invested on the stock market through him, and it has made a difference in how I live in my retirement. I have a couple of questions arising from the presentation. The first one, I think, has to do with Mr. Chihana said about, is it 9 protection benefits that are available worldwide as a standard, and that Malawi is not yet making available those 9. Did I hear you right? Yeah. And my question is, what if Malawi were to implement all those 9 protection benefits, wouldn't there be a corresponding rise in the taxes from which we are already struggling? The second question is, since the amendment of the law to do with remission of pension funds to the funds, to what degree would you say the compliance has improved? That can indicate, for example, what the situation was like before the law and what it is now. Thank you.
I think I'm aware of probably 3 or 4 somewhere thereabouts that are available in Malawi. And indeed, you are very right. For us to be able to provide all the others, we certainly need to have the fiscal space to do it. And that is precisely, I guess, the reason why we are not able to do it, because we don't have the fiscal space. Certainly, if we're going to do that, then either taxes have to go up somehow, or maybe the revenue base for the taxes has to be expanded. But I guess that's a headache for government more than what we can do here from our perspective. So yeah, I think to answer your question, yes, I think it would almost certainly mean that there is going to be more expenditure on the side of government. And as to how they can achieve that, I think that's a conundrum that really needs to be solved. In terms of compliance, okay, so before the law, there was no mandatory requirement for people to be on pension. So the companies that were really offering pension were those that could afford or have made that choice. Most of the employers were not offering or putting placing people on pension. I think it was mostly for those that were in white collar jobs, mostly. For the rest, they were actually falling back on they would only pay maybe the severance allowance that was there in the Employment Act of 2000, especially, and the ones before. So I think in terms of after the implementation of the law, the major challenge that we've had is that because we don't have a database that shows the number of employers in Malawi. We have tried to work with the Ministry of Labor on this. For some reason, they don't seem to be maintaining one. And this is why I think we have also tried to leverage on the information that MRA has. But MRA, it would include all the taxpayers, the employers that have been paying tax. Some of them would have maybe collapsed along the way, but they still keep them on their register. So it's also not a very good number to work with. So the only numbers that we have are the ones that we probably have in our custody as to be the ones that have provided membership. I mean, less employees on pension. So I think for the precise numbers, I can get back to you somehow. I can find you. But overall, the majority of employers in Malawi actually do comply. But it's the few that don't comply mostly
they do a very bad job at not complying, or they do a very good job at not complying. They are not complying at all, some of them. So the main ones, the main culprits that I would cite as having substantial amounts would mostly be the parastatals and probably government in terms of the numbers. The private sector, we still have a few employers as well, but generally speaking, overall, I would still put that the majority of employers actually do comply rather than not comply. Yeah, thank you.
So clap hands for yourselves, you're complying. The final question, and maybe perhaps our two speakers may wish to comment before we finally wrap up after that.
Thank you. Stated is the one that I want to ask on, because I work in the private sector. I am Macmillan Jakara from Times Group. Looking at the first three questions, you can easily tell that most people are not into trading or manufacturing. They are mostly work in government-owned enterprises. And they don't even know that parastatals are on the top list of non-compliance. Looking at the economic situation in this country, the forex issues, you even begin to wonder where an employer is going to put pension money. Its pension money is not just 10 million, these are big, big checks. So, why am I saying all this? The issue of that penalty. There are calls that no other bill should increase the penalty. I'm like saying, do these people even know what the penalty is? Ladies and gentlemen, indikatapila wenyi penalty RBA. Actual indikatapila. If you don't know, Employers Association of Malawi, there are calls that this law should be revised. Why should it be revised? Okay. For that employee whose company was compliant, paying pension perfectly, they may get, at the end of the return engage, they may get 50 million. For that person whose company was defaulting, when that penalty is factored in, they are getting 70 million. That's the difference. The person who is enjoying the default will enjoy more. So actually, if you ask employees, they would rather the company default so that they enjoy that penalty. I've never come across an employee who had received the same amount as the one whose remittances were being remitted perfectly. Am I trying to say companies should default? No, not at all. Companies should suffer the consequences of not remitting pension. But at what cost? Should it be at the cost of caterpillar? Okay, if that extra sum is given, the penalty sum is given, who is supposed to enjoy it? Can there be some sort of a fund? Reduce the rate, and there should be introduced some sort of fund. I just want to put that idea across to say, when people are saying, no, companies should be penalized, it's mostly these companies that enjoy government money. But if you want me to say, go close the Black Water Board, really, can we be happy to say, Black Water Board has been closed because of penalties? We are happy. I mean, these are utility companies. So it's something that RBA should think about. Don't just say, companies are not complying. No, this penalty. I'll give you an example. I know companies that had calculated to say, if you had sold out all these people whose pension is not being paid in the past, how much would it cost us? You go like, this will cost us maybe 600 million. You go like, really? We should just get 600 and dump it into those guys. If you are doing that, then we are downsizing. We are moving every day. Is what employees want. So I just want people to be careful when they are jumping up and down saying, oh, you should come hard, you should penalize. It's not all that. There are a lot of factors that go into these things. Thank you so much.
Penalty when it is paid. I want to make sure that this is actually very clear because I don't want people to have a misconception. When the penalty is paid, it is actually paid to the employee's account. So there is no penalty amount that goes to the Reserve Bank. Okay? This money goes to the employee. Remember that I think the benchmark of RBM policy rate is really just to speak to the fact that generally speaking interest rates would move in tandem. When you look at the RBM policy rate is more like a guiding policy rate, and therefore the general trend of interest rates will tend to follow that pattern. And that's why I think it was tagged to the the policy rate to say add 10% as a penalty for not complying. And so the general expectation was that ideally that would correspond to the sort of return levels that pension funds would actually enjoy. In some circumstances, if we had to take, for example, last year, with the sort of returns that were experienced on the stock exchange, you will notice that the one who was receiving the policy rate plus 10% actually got lower. Very much lower than what people enjoyed on the stock exchange. So it's not always the fact that the policy rate will give you a higher return than those that were actually compliant. And for your information, for quite a number of years, in as far as we are aware, pension funds have been beating the inflation rate in terms of their investments. So, but then you find that in some cases, even a much higher than the policy rate itself, and they are insured the penalty. So, I don't know. I would not want to generalize it in that fashion to say that those who had their pensions not remitted to their pension fund, they probably end up with a higher return. It is possible in some circumstances for that to happen. But I think what is more important is for the employer to simply comply. Why should they wait for them to be imposed with a penalty? To begin with, even if, let's take out the penalty in the first place, most of them, even just to remit the amount that is required by the law, the minimum, they fail to do that. That is where the problem is. And then all you are saying is, look, by you not remitting, the member is losing out on investment income. And therefore, we must compensate them somehow. Unless if we find another reference rate that we can use, well and good. I mean, we don't have to amend the whole law just for us to do that. Because to me, that is just a regulation. There is one regulation that we have to amend if we want to change. But it's a question of just changing the benchmark and not necessarily changing the whole law. I think, I think that's all I can say on that issue. Apart from that, I've been asked to also make my final comments. I think it's just to appreciate the Continental Group for inviting me and my colleagues. They have been quiet. I know they're hiding somewhere here, two of them. But just to appreciate for inviting us to be part of this panel discussion. Any panel discussion or meeting that we participate, it's always eye-opening, and we always learn new things in terms of getting feedback in terms of where you are meeting challenges with the law and whether there is need for us to also have a rethink in terms of our approach regulatory. So we really appreciate all the feedback that we have received. We are always available where you need us to come in and also talk about any law, to provide any clarifications on any particular issue. And yeah, I think also just to appreciate the retirees, not just the ones on the panel, but those in the forum as well. Your life experiences actually are the most important ones to educate people than what we can say, because for most of us we will talk from a theoretical point of view, but when you speak, it's a life experience, and therefore people actually appreciate it more and we can listen to you more. And I think I really appreciate the fact that Continental, you thought about bringing the retirees, which is something I've not seen quite a lot in most of the awareness. So thank you so much.
Now, before we go back to the big hand for you, please.
Appreciate our panelists for the job well done. I think you have demystified quite a lot about retirement. I think you've given us clarity in terms of what we should expect based from experience. As I had mentioned, I'm barely 6 months in retirement, so I haven't accumulated much experience. But I want to acknowledge that being in retirement is totally different. And the thing is, you really indeed need to adjust. And I think I'm in the adjustment phase. Now, quickly to react to, I think, one of the issues that was raised. I know Director Kaluso tried to explain more particular about the arrears, pension arrears. As a former regulator, so I was being the one responding to some of these issues. So I'll still wear my regulatory hat to say pension arrears should not even be an issue, because here we're talking about the laws of the land. And the laws of the land are very clear. Pension deductions and contributions should be remitted within stipulated time frame. And that should be the issue. Someone who doesn't do that means he's breaking the law, and there should be a penalty for that. This is why you find the regulator or even the law stipulating that administrative penalties with respect to non-compliance. So let me mention that actually I think the current approach in Malawi has been very new. Because out there, the laws even provide for people to be jailed for withholding workers' money. The truth about it is, if you deduct someone's pay, remember, pension contribution is earned. If at the end of the month we didn't come up with this mandatory law, I speak specially about the mandatory law because we are the architects, the people who came up with this particular provision. We said, for the sake of safeguarding people's welfare in retirement, there should be something that should be done. This is a social responsibility of government. So if someone deducts that money and does not remit, basically is defrauding that person. Actually, it's theft. And you know what happens with thieves. They're supposed to be arrested and jailed. Sorry. So if I look at the 10%, because the only penalty there is the 10%. It's just a deterrent. Because basically the policy rate is an opportunity cost. You are saying if this money was invested, at the minimum, maybe this is what they would have received. So I believe that at the moment, this is all right. I actually know that the law is also providing that in the event someone doesn't comply, there should be prospects of even closing the business premises. That's the law. And I'm imagining what will happen if someone uses your money and at the end of the day files for bankruptcy or liquidation. What happens? I was just sharing with the CEO here that there are people who have been coming to the registrar's office to complain that they don't have their pension money. What happened? Because the employer has wound up, and there's no avenue for those people. They've lost their pension. So I think with regard to issues of arrears, I strongly still strongly advocate that there should be strict enforcement of the law, so that at the end of the day we don't jeopardize people's welfare in the country. Now the second comment that I can mention is to say, for compliance, because most of the time I think these issues are because even they're deliberate by the employers. It's very important that the issue of financial literacy really should be advanced and enhanced. The reason would be if the employees really are aware and knowledgeable about their rights and obligations and expectations from their employers, they themselves should also take part in trying to get their employers to comply with the requirements of the law. Otherwise, just as it was being mentioned, most of the time, workers they don't even know what rights they have under the Pension Act. So this is the biggest challenge that I see. So I think market players together with the registrar, I still believe that there is need to do more in the area of financial literacy. I believe once the employees are aware of their rights, they will take up these matters, and I would see the issues of pension arrears or non-compliance. I think they are reducing over time. Let me stop there. Thank you very much.
Thank you. On my part, I just want to thank the panelists for ably unpacking the subject on the table, from compliance, regulation, fund management, administration, and then the lived experiences of our distinguished retirees. I think several themes are coming through. Number one, the need for greater awareness training. So the awareness is indeed, there is a gap in awareness on the market, and that's something that one of the lessons that we are taking home, the need to educate and make our employees and individuals aware of pension regulation and pension provisions and what their rights are. Also, the need to start planning early, as ably advocated for by the retirees, not only the distinguished ladies in front, but all the retirees in the room chipped in, and thank you for that. While we are there, I just wanted to add my voice to one issue, and that's the issue of Abusa, who said, look, I've enjoyed good growth on my investments, and now I can see erosion. And Director Kaluso actually said, look, if you talk long term to Madam Makhumbo, she will understand you. But if you're talking long term to a retiree, there's a different understanding, and I agree with that. Just to say that when we are looking at investments, and James in one of his comments, he did say that when we look at investments, when you are transitioning from the accumulation phase, now going into the decumulation phase, we look at number one, the kind of assets that you are investing in. and we tend to reduce the proportion of the long-term, in quotes, riskier assets to the more stable assets. So we move, let's say, from equities to interest-bearing assets like fixed deposits and government securities, just to ensure that there is liquidity and while you are still enjoying growth. But on that proportion that remains, the equity proportion, you may still experience these fluctuations. And we still use the terms short-term and long-term, but with different perspective. When I'm speaking long-term to the Reverend, I'm talking the next 1 or 2 years, and I'm saying, over how long are you seeing this decline? Is it over 2 months? If it's over 2 months, can we focus on the past 2 years and the next 2 years? And do we need to make changes to your portfolio? If not, it depends on the factors. So sometimes we tend to discourage reacting to very short-term factors, because at the end of the day, you still know that when you plot the graph over the longer term, and longer term might be even 3 to 4 years, you will see a different result. But nonetheless, we still recommend changing the mix of assets so that you have more stable assets and less volatile assets. That's what I would say. Thank you.
Thank you, Angel. I think it's hard to come up with remarks after your CEO has already wrapped up everything. But all the same, just to appreciate our retirees for the lessons that they have given us. We've learned a lot. And just to encourage everyone to take keen interest in the matters of our pension, as we have been ably taught by our retirees. Let's take keen interest in how our pension is growing, and even our investments, how they are growing, so that we enjoy pension as we have learned from our retirees. Thank you.
Thank you so much. So quickly, I would like to say that, sitting in this room, we only representatives from institutions. We are trustees, we are HR personnel. We have heard so much today. I was actually telling him that after the Mr. Makhumbo spoke, that we've been preached to. Like we can just close. He touched on most of the areas concerning pension, but there are so many out there who haven't heard what we've heard today. So I'd like to say, those of us in here, let's be ambassadors in our offices. Some of us sit in some church settings where we have the opportunity to talk to people. Even in our homes, let's start educating our children as young as primary school about these things. I'm sure they will be very grateful. And growing up with this information, I wish I'd known some of these things way back. But well, they say it's never too late. So I'm taking that we will be ambassadors wherever we go to educate others as well. All the appreciations have already gone, so I can't be grateful enough for me also sitting here. Trust me, I've learned a lot. So thank you so much.
Continental Good Company for organizing this discussion. Has been a fruitful one for us all in here. And it's just a matter of aging. Those who are about to retire, to think what to do next. Don't be so ambitious, as I said already. Think for your future and your grandchildren's future. Leave something behind before you leave this world. You should remember you for that. Thank you so much.
My last word is simply to thank Continental Asset Management for inviting me to come and share in this forum my experiences as a retiree. Retirement is a liberating experience. I'm enjoying it very much, so look forward to it. Don't be afraid. Just prepare. Thank you.